Thanks for starting your week with us. Hello and welcome to Business Daily. I'm Lee in Seoul. Before we get started, let's take a quick look at what highlights we have lined up for you today. With the year nearing to an end, we take a look at how global stock markets did this year and what factors might affect Korea's market performance in the new year. Korea's real estate market boomed this year thanks to the record low interest rate. But growing household debt, oversupply, and tighter lending rules might signal an end to that boom. But first, Korea's household and corporate debt to GDP ratio hit a record high in the third quarter amid already growing concerns that the country's debt levels are posing serious risks to the domestic economy. Our Hwang Jae has the details.
The Bank of Korea says the amount of household and corporate debt in Korea was almost 2 times higher than the country's GDP in the third quarter this year. The debt-to-GDP ratio stood at 182.6%, marking a new high. The figure edged down in the first quarter but breached the 180% mark for the first time in the following 3 months. Household and corporate debt includes loans and sales on credit. The record amount in the July to September period came on the back of surging household debt caused by eased real estate regulations and a record low key interest rate. Riding on the government's measures to boost home transactions, the central bank cut the key rate 4 times in less than a year period starting August last year. Given that, analysts warn the debt burden is becoming a potential risk for the economy.
If house prices drop suddenly, the debt problem will emerge as a serious issue that could worsen Korea's financial health and trigger a full-blown crisis.
Third quarter household debt grew at its fastest pace since 2002 when the data were first compiled. The amount of debt stood at over $1 trillion as of the end of September, up roughly $30 billion from the end of previous quarter. Experts add the snowballing household debt could also dent consumption in the longer term as people will save money to pay back their loans. Hwang Jae, Business Daily.
We keep hearing about record low oil prices, but have you ever wondered where the cheapest gasoline in the world is? Well, it turns out Venezuela tops the list. According to globalpetrolprices.com, the price of gasoline in Venezuela is a mere 2 cents a liter. This means drivers in the South American country can fill up a compact car for about $1. To compare how cheap this is, the average global price of gasoline is slightly under $1 a liter. Now, Korea's gas price is the 50th most expensive, standing above the global average at $1.21 a liter. Gasoline is most expensive in Hong Kong at $1.84 per liter, and gas prices in European nations hovered above $1.50. Each nation's gas price includes fuel taxes and subsidies. And now it's time for a look through some stock market action. And this week, not only do we have fresh updates, but a review of the past year, as well as what we can expect from the new year. And for that, we have economics reporter jeonse from SBS CNBC joining us on the phone today. Hello there, jeonse.
Good afternoon, Jian.
So let's get started by looking at the Korean stock market. Now, tell us how the market did on the first day of this year's last trading week and last week in general.
Yeah, today's market failed to continue last week's positive performance. Both indices showed a modest decline, while the Kospi expanded its losses more than 1.3%. Both foreigners and individual investors were net sellers, even though institutional investors continued to buy stocks. In terms of last week's market, the Kospi rose by 0.47% during the holiday-shortened week, helped largely by institutional investors. Institutions bought as much as 1.2 trillion Korean won or $1.2 billion worth of stock last week. Although foreign investors continued to sell stocks for 17 consecutive sessions, the amount of their sell-off showed a slight decline because of an upgrade on Korea's credit rating announced by Moody's.
Let's take some time to look back on market performance in 2015. First, how did stock markets in developed countries perform throughout the year?
Although there's still the possibility that the U.S. equity market might continue its positive trend on an annual basis, the largest stock market by size has been moving mostly sideways all year long. As of last week, the Dow Jones Industrial Average fell by 1.5% year to date, while the S&P 500 and the Nasdaq posted 0.2% and 6.6% of gains respectively. Some of the reasons behind this first have to do with the so-called valuations in the market losing attraction this year. In other words, the U.S. stock market has become more and more overpriced. Secondly, earnings growth has been sluggish. Finally, uncertainties surrounding the timing of the Federal Reserve's first interest rate hike followed by the strong dollar have made investors more cautious. In contrast, central banks in the Eurozone and in Japan continued pumping money into the market. As a result, both markets have outperformed the U.S. as the Pan-European Stock Market Index Stock 600 rose by 7.4%, and the Japanese equity market surged by 7.5% this year. Market experts predict this trend will continue in 2016. According to America's premier financial magazine, Barron's, major investment banks see a 6 to 7% upside potential for the U.S. market. However, they're becoming a bit more cautious, urging investors to be more conservative. Meanwhile, European and Japanese markets are expected to rise largely due to stimulus momentum in the region.
Then what about emerging markets this year? I mean, China no doubt dominated the headlines.
That's right. The biggest emerging market, China, has gone through a roller coaster ride for the entire year. The Shanghai Composite peaked on June 12 at 5178 and then plunged as low as 2850 on August 26. Market jitters in late August spurred concerns throughout global financial markets as well. Despite this extreme volatility, the index still showed 12% in gains this year. Moreover, there have been more upbeat forecasts for 2016. Especially, experts have high expectations toward what policymakers agreed on during the annual Central Economic Work Conference. The Chinese government pledged to further stimulate the country's economy both through fiscal and monetary policies. Structural reforms that will focus on reducing the country's overcapacity are expected to be a positive catalyst for the stock market as well. Other emerging markets, including India and Vietnam, are becoming more popular among investors too. The Vietnamese economy grew by 6.6% this year, marking the best result in 5 years. Like this, more rapid growth and tangible results from structural reforms are some of the many positives in these markets. On the other hand, the markets highly exposed to falling commodity prices such as Russia, Brazil, and Indonesia are expected to continue to struggle next year.
And lastly, how did the Korean equity market do this year, and what are the expectations for next year?
Yeah, as of today, the Kospi rose from 1915 to 1964 this year, or up by more than 2.5%. Of course, it's not a bad result, and the index reversed from its negative trend last year when it fell by 4.8%. But the Korean market failed once again to escape its consolidation period for 6 consecutive years. The Kospi once rose as high as 2189 on April 24. However, worries surrounding the Fed's rate hike and China's economic slowdown, a crash in the country's biotechnology sector dragged the index down to 1800 in late August. There's even a wide range of pessimism towards next year's market performance. According to 10 major brokerage firms, the Kospi is expected to fall as low as 1849 or rise as high as 2223 next year. These expectations have been lowered over time as market analysts forecast negative factors that affected the market this year will remain in 2016 as well. Daishin and KDB Securities both expected the index can even fall to 1700, marking the lowest estimate among the firms. The Korean market is likely to be affected heavily by external factors in the new year as well. In other words, there are some positive catalysts outside the country, especially an economic rebound in China. We can expect a surprise rally in the market as well. This has been Choi Jin-seok from SBS CNBC.
Hanwha Galleria, the retail arm of Korean conglomerate Hanwha Group, has partially opened its duty-free store in Seoul. Showcasing some 370 brands, the duty-free shops are located within the 63 city building that is, one of the best-known landmarks nestled in the country's financial district of Yeouido. Hanwha plans to revamp an aquarium and restaurants in the building and eventually transform the venue into a new tourist and shopping hub. The company also hopes to post annual sales of over $430 million next year and $2.6 billion through 2020. Meanwhile, the grand opening is scheduled for June next year. The value of automobile imports this year in Korea for the first time ever exceeded that of vehicles exported by three smaller local players in the market: GM Korea, Renault Samsung, and Ssangyong Motors. Korea Automobile Manufacturers Association said the country imported roughly $8.7 billion worth of cars in the January to November period. Now, this outpaces the combined exports worth $7.6 billion posted by the three automakers. In terms of volume, however, the Korean producers outstripped the import manufacturers by 310,000 units over the same time period. Now, experts say the presence of import cars has been growing due to aggressive marketing tactics, and Korea too must respond by stepping up efforts both in and outside of the country. On the back of record low interest rates, the real estate market saw huge gains this year, but with this came a score of other problems as well. Our Lee Joo-young gives us an overview of the housing market.
Korea's real estate market this year saw a major boom, something most housing experts like the country's market information provider Real Estate 114 will agree on. Even with over 510,000 new homes up for pre-sale this year, a 60% increase from 2014, the competition to buy newly built homes was almost double that of last year, with roughly 1 out of 12 landing the right to purchase. Experts say the upswing was largely due to a set of measures launched by the government, including the extension of relaxed loan-to-value or debt-to-income ratios and various tax waivers to boost the housing market. And with the shortage of affordable lump sum jeonse properties coupled with the country's record low interest rate, Koreans have been taking out loans from banks to buy their own homes instead. Starting from March this year, apartment sales surged by 100,000 units on month, putting accumulated home transactions at 1.1 million units as of November. But on the flip side of this all, the growth in mortgages had led to a giant swell in household debt. Outstanding household debt has surged beyond $996 billion as of end September, with home loans being responsible for 70% of that figure. The Bank of Korea says a growing number of households are struggling to pay back their loans, with the country's household debt to disposable income standing at 143%, up 5 percentage points from 6 months ago. Lee Joo-young, Business Daily.
Startups here in Korea are growing in number as well as in their performance. A report released on Monday by SME and venture business groups showed that the number of startup companies last year, including those preparing to launch, came in slightly under 30,000, recording sales of $184 billion, or 14.5% of 2014's GDP. Their average sales expanded, bringing in 11.2% more on year and beating the growth rates of both conglomerates and small and medium-sized businesses for the 6th consecutive year last year. The report also showed that startups spent more per ratio of sales on research and development, which is double that of conglomerates. It's not unusual to see coffee shops lined up one after another as you walk down the streets here in Korea. And such an explosion of cafes in the country has led to market oversaturation. So while trying to compete against foreign coffee giants here at home, local chains are also looking to go overseas for more opportunities. Here's our Park Se-young with more.
Coffee chains are a dime a dozen on the streets of Korea these days, with nearly 50,000 cafes nationwide. That wasn't the case nearly 20 years ago when the first foreign chain started setting up shop here. The first successful one was Starbucks, which opened in 1999 and had expanded to over 800 by 2012. Idia Coffee followed in 2001, becoming one of Korea's first homegrown coffee chain. It went on to open over 1,700 shops across the country, while Angelina's opened nearly 1,000 branches around the same time. The foreign chains used to be the biggest draws, but that's just one of the trends that may be changing in Korea's crowded coffee market.
I used to go to foreign chains, but lately the coffee from Korean chains has become tastier and more affordable.
Still, there's only room for so many cafes. And their expansion was curbed when in 2012, the Fair Trade Commission banned coffee companies from opening a new branch within 500 meters of another. As a solution, Korean coffee chains have turned to the foreign market. Korea's coffee giant Cafe Bene has ventured into China and the US, while the newer franchise Coffee Bay recently signed a contract with Walmart for US launch. Meanwhile, with the chain's rapid expansion, the instant coffee market has suffered dramatic losses, and they too are seeking to export their products overseas. Park Se-young, Business Daily.
And that wraps it up for today. Thanks so much for watching, and we'll be back tomorrow with more, so don't forget to tune in then. Until then, goodbye.